Hello and welcome from a gloriously sunny day in the UK in the midst of our Corona-19 lockdown. Before starting this short video message, I'd like to hope that all of you are well and safe and coping with this rather strange new world in which we all live across the world. I'm going to today be introducing you to Alex Rogan, who's a partner in our restructuring group, because we're very conscious that the perfect storm of COVID-19, a significant drop in oil prices, turbulence in the stock markets, and all of this following on 5 years of really difficult trading conditions for our clients and friends in the oil and gas sector has made life even more difficult. And Alex and his team may be able to assist you. So, Alex, tell me why a non-UK company, as most of our clients and friends are in this sector, should want to use the UK restructuring tools to assist it in any restructuring options it wishes to consider.
Thank you, Gillie. So the starting point is for a foreign company to consider its restructuring options in its local jurisdiction and determine whether they are capable of delivering restructuring in a cost-effective manner with the requisite level of certainty in terms of delivery that maximizes value for stakeholders. To the extent that is not the case, then it's important to look at other options, and the UK scheme of arrangement, along with Chapter 11, are often considered together for foreign companies to determine whether they're appropriate. And the UK scheme has its pros and cons as against the Chapter 11 process. What the UK scheme is very good at is delivering balance sheet restructurings of companies with a high level of certainty around outcome in a cost-effective manner, arguably more cost-effective than the Chapter 11 process, as a result of it being less of a court-driven process with less public disclosure and a lesser platform for litigation and disputes to be aired.
Thanks, Alex. That's really interesting. And tell me, are there any restrictions on the extent to which a non-UK company can use these options?
So there's a very low jurisdictional requirement for the English scheme of arrangement. Essentially, it's necessary to establish that the company has a sufficient connection with the UK, and it's possible to do that in a number of ways. One is to move the COMI of the foreign company, that's its centre of main interest, to the UK. Another is to establish it on the basis of the governing law of the finance stocks, the claims that are being compromised. To the extent that English law governed claims, then that is sufficient to establish a connection. And there's precedent for even changing the governing law of foreign law governed finance documents to English law, and then conducting a scheme on the basis of that connection. So there's a variety of ways of establishing connection. It's a low threshold, and we'll cover that in more detail in the seminar.
Thanks, Alex. That's encouraging. And tell me, early or late, I'm sure as lawyers we're going to say early is better than later, but when should these companies start looking for restructuring advice if they're suffering significant business operating challenges?
So companies need good cash flow forecasts, and particularly in today's environment where there is extreme uncertainty around revenue. Typically, cash is king, and typically it will be coupon payments, interest on financing, or maturity repayments of financing that drive the need to consider restructuring options. And the earlier that companies engage with their restructuring options, the better. It preserves optionality and allows allows the potential to maximise value.
Thanks, Alex. As thought, early is indeed better than late. So, Alex, what about the problem that you have a number of members of the board who wish to proceed with a restructuring, but they've got the problem that not all the company stakeholders are on board with that idea? Is there any support we can offer companies in that situation? Any guidance that we can give them?
The aim of any restructuring is to have a consensual solution whereby all stakeholders sign up to revised financing terms. The company is restructured and has a revised balance sheet which reflects its new business plan, fits with its new business plan, and is capable to operate competitively and grow in the future. Thereby, often returning value to stakeholders who've swapped their debt positions for equity. To the extent that it's not possible to achieve a restructuring on a consensual basis, then it's often it's necessary to look to the restructuring tools. As I said earlier, start with looking at the local restructuring tools, and to the extent they're not capable of delivering a restructuring, then the UK scheme of arrangement is in many circumstances the most effective tool to deliver a restructuring. It's capable of essentially imposing a statutory contract upon dissenting creditors when the requisite majority of creditors vote in favour of the plan. That being 50% in more than 50% in number, representing 75% in value. And the other thing to always bear in mind is that in order to achieve that consensual solution, it's often necessary to have the restructuring tool like the scheme of arrangement in the background to encourage the dissenting minority creditors to sign up to the deal, and thereby success is measured in the fact that the restructuring tool is never deployed in the first place.
Thanks, Alex. That sounds encouraging. Okay, that's great. Thank you. We will shortly be sending you further details of our upcoming restructuring webinar when Alex will be discussing all these questions and more in further detail for you. If in the interim you would like to talk to either Alex or myself on your restructuring options, or indeed anything else on which we might be able to help you, please do get in touch with us. We'd love to hear from you. In the interim, stay well, stay safe, and good luck. Thank you.